One of the most popular investment research platforms for both individual and institutional investors is going to be Morningstar. I actually think they provide a lot of unique tools that can definitely help you in your investing journey, but one of the interesting articles they just released was their 10 best dividend stocks for the second half of 2025. So in this video, we're going to be conglomerating the data, looking at the trends we're seeing with their stock picks, and taking a closer look at all their picks as well. I also want to mention that Ticker Data is still currently running their Independence Day sale where you can get 30% off the annual premium plans. Ticker Data has ready-to-use automated portfolio tracking tools, stock analyzing tools, and it allows you to automatically import stock financials directly into your spreadsheet. So again, use code FREEDOM at checkout to get 30% off the premium annual plan. Now let's go ahead and dive in. Now, to start off, we're looking at the top 10 dividend stocks for the second half of 2025, and we can see this is an article they released just a couple of weeks ago. Now, the first half of 2025 was quite volatile, as we all know, but the market has actually done quite well. When we look at the heat map of the S&P 500, we see green pretty much in all the areas that we look at. And so because of this, since 2022, we've really been in the midst of a massive bull run. The S&P 500 over the last 3 years is up close to 64%. So let's go ahead and take a look at Morningstar's top 10 picks and seeing how it shapes up to the market. Now, before Morningstar reveals the pick, they make an important statement. At Morningstar, we think that the best dividend stocks aren't simply the highest dividend stocks or top performing dividend stocks. We suggest that investors look beyond a stock's yield and short-term performance and instead choose stocks with durable dividends and buy those stocks when they're undervalued. I think that's a good statement. I couldn't agree more. Let's see if they stuck to this. To find the best dividend stocks, they turn to the Morningstar Dividend Yield Focused Index. The dividend stocks on the list are among the index's top, and they were also trading in the 4 to 5 star range as of June 13th, 2025. So look at these holdings. We have ExxonMobil, Johnson & Johnson, Merck, Pepsi, COP, which is ConocoPhillips, Medtronic, MDT, L&T, which is Lockheed Martin. We have MDLZ, OKE, and Schlumberger SLB. Now, I immediately wanted to get some insights into these picks, so what did I do? Well, naturally, using Ticker Data, I created a spreadsheet with in-depth details on all of these holdings. And I know at first glance it looks a little chaotic, but there's some pretty interesting takeaways we can see by looking at this key data. Now, to start off, one of the things that I do want to point out is look at the year-to-date change of all of these holdings. Out of their picks, only 4 are in the green year to date, and we have some holdings that are down around 18 or even 19%. And then if we look at the 3-year return, we can see we have 4 different holdings that are actually in the red over the last 3 years, and in fact, we can see every one of these stocks has actually underperformed the S&P 500 over the last 3 years. Again, S&P 500 up about 64%. Now, the caveat I will make to that, if you're someone who's currently looking to live off dividends, trying to outperform the S&P 500 should not be your goal. It should be a sustainable, growing stream of dividend income, so that is something to make note of. But with that being said, why is it that these picks have underperformed the market over the last 3 years? Well, we have to remember, what moves stock prices over the longer term? In the short term, stock prices are moved by market sentiment. It's moved by news. But as we get longer in our time horizon, it's moved by earnings growth. It's moved by free cash flow growth. So how have these stocks been growing their earnings over the last 5 years? Well, let's go ahead and take a look. If we look at the 5-year earnings per share CAGR, we can see there's a couple of examples where earnings have actually grown pretty well from ExxonMobil, from Merck, from OKE. But for the most part, earnings growth has been relatively slow. In fact, if we jump over to the other part of the spreadsheet, we can see the average 5-year EPS growth for the holdings in their picks is only about 5.87%. Now, what's interesting about that data point is if we look at the S&P 500 earnings per share over the past decade, we can see that average growth rate is coming in at about 8.13%. Now again, it's not perfect to compare these holdings to the S&P 500 because obviously the S&P 500 has become very tech heavy, but it is worth noting they're growing earnings on average slower than the S&P 500. What about the valuation? Well, here we can see in the yellow stocks that are trading above their 4-year average PE ratio, and in the green we can see stocks trading below their 4-year average PE ratio. So we can see stocks like ExxonMobil, stocks like ConocoPhillips, Lockheed Martin, Mondelez, all trading below their 4-year average PE ratio, which at times can be an indicator that the stock is undervalued, especially if their earnings are still growing at a healthy rate. But again, one of the things I can't help but notice is if we look at the S&P 500 PE ratio right now, we can see it's sitting at about 22 times earnings. Now, with that being said, the S&P 500 sitting at 22 times earnings is quite a bit above its historic average of 17 times. Some would make the argument that this means the S&P 500 is overvalued, and some would make the argument this is due to the fact that there's many holdings in the S&P 500 that are higher quality and now growing earnings at a higher rate than historically speaking. But regardless, looking at the PE ratios of these stocks compared to the S&P 500 continues to help us get a better understanding of what types of stocks we're looking at. So far, most people would describe these stocks as value stocks. But now we've made our way to some dividend metrics. We have dividend growth metrics and dividend yield. Let's just go ahead and start with that dividend yield for these stocks. We can see the lowest yielding dividend stock on this list is Mondelez at about 2.73%, and then the highest yielding a little bit above 4% with PepsiCo, about 4.05% on a trailing 12 months basis. That's going to be a little bit higher on a forward-looking basis. But the dividend yield obviously doesn't tell us enough about these stocks by themselves. We need to understand, are they growing those dividends at a healthy rate? Well, it varies quite a bit depending on which stock we're looking at. We have some stocks like Schlumberger which have actually reduced their dividends over the last 5 years. We have some stocks like ExxonMobil and OKE which have grown their dividend at probably a rate below inflation, which technically means they're paying out less in dividends every single year. But then on the flip side, we have stocks like Mondelez, very healthy dividend growth at about 10.43%, ConocoPhillips about 8.5%. So if we look at the average 5-year dividend growth rates, it comes out to about 5.54%. Now let's pause there for just a moment. We can see something really interesting here. We have to remember what drives dividend growth over the long term. It's growing free cash flow. It's growing earnings. In the long term, a stock can't grow their dividend at a faster rate than they grow their free cash flow and earnings. And what's so interesting is look at that average 5-year earnings growth rate, 5.87%. The 5-year dividend growth rate is just below that at 5.54%. Over the long term, stocks can't grow their dividends at a faster rate than earnings and free cash flow, and we can see this visualized right here. Now, on top of this, the average dividend yield for these stocks is coming right in at about 3.5%. Now, there's more data we need to look at, but let's pause there for just a moment. One of my biggest complaints about people who talk about dividend investing is they don't understand there are different subcategories within dividend investing itself. For example, a few months ago, I put together a very in-depth video that's over an hour and 10 minutes long called How to Build a Dividend Tsunami in 2025. But one of the key things we talk about in that video is how there's different subcategories of dividend investing. For example, we have people seeking out high yield. We have people that are more defensive dividend investors seeking capital preservation and more low risk. And then we have what I would describe primarily myself right now, a dividend growth investor. This is for investors looking to maximize dividend income and returns over the long term. This is stocks that grow their dividend payments at a high rate. Now, the question is, how do we determine what type of dividend investor we are? What should we be looking for? That's a good question, and this is where the dividend growth pyramid comes into play. And this is a visual from my friend Jake over at Dividend Growth Investing. What we can see when we look at this dividend growth pyramid is as our investment time horizon expands, we should be focusing more on dividend growth stocks. Think of stocks growing dividends at a high rate, but might have a relatively low starting dividend yield. Think of stocks like Visa, Lowe's, Costco, and Microsoft. And then as we come to the bottom of the dividend growth pyramid, we have more high-yielding stocks, but don't necessarily grow their dividends at as much of a high rate. Think of stocks like Altria Group or real estate investment trusts. But then somewhere right here in the middle, we get a mix of both. These are typically more time-tested stocks with very durable business models. These are the type of stocks that a lot of the times I would describe as more defensive dividend investing. Now, as far as determining where you should be in the dividend growth pyramid, you have to ask yourself questions like, what's your time horizon? What are your goals? What is your risk tolerance? And what is your strategy for adjusting your portfolio over time? For example, if we look at me right now, again, I'm focused for dividends on the long term, so I'm focusing a lot of my portfolio on high levels of dividend growth, stocks that will grow their dividends at a high rate. It's because I have a long time horizon. But as I get closer to actually living off dividends, I start to go further and further down the dividend growth pyramid, looking for stocks with higher yields. So what's the point I'm trying to make with the holdings currently in Morningstar's top 10 dividend stocks? Well, when I look at these holdings, it's pretty clear. The picks they've made don't fall into the high yield category, and they don't necessarily fall into the dividend growth category. These are defensive dividend investor stocks. These are probably stocks for people that already have a relatively large portfolio and care a lot about capital preservation. preservation. They're not overly concerned with trying to outperform the market. They're looking for stocks that are typically in this category that have time-tested business models. Now, there's not necessarily anything wrong with that whatsoever, but I do want to make note. It's really important that you understand where you are in the dividend growth pyramid, because right now, if you're looking to maximize total returns and dividends over the long term, this is probably not the list you should turn to look for dividend investment ideas. And at the same time, I would also argue if you're looking for high yield plays, again, this is probably not the list that you should turn to. If you're a dividend growth investor, the holdings in your portfolio need to be growing their earnings at a faster rate. They need to be growing their dividends at a faster rate. And if you're a high yield investor, you probably want to buy stocks with an even higher starting dividend yield than an average yield of around 3.5%. So the point I'm trying to make, it's absolutely critical to understand exactly who these picks are for, because for the ideal candidate, these could be pretty decent picks, but for a lot of people, these are not dividend stocks that I would recommend. Now, with that in mind, let's look at our last few categories. One of the things that I always love to look at that I think a lot of investors don't pay close enough attention to is return on invested capital. Now, what is this telling us? It's telling us how profitable are the projects that the company is investing their capital into. So as a baseline, we typically want to see around 10% for mediocre businesses. And if we look at the average ROIC for the stocks on this list, we can see it comes in at about 11.46%. So that's pretty standard. Again, as a baseline, we want to see around 10%. Higher quality stocks are typically going to get around 20%. But then finally, you can see we have a 4-year price target and then the 4-year upside based on that price target. Now, complete disclaimer, this is not my price targets. We did a very straightforward methodology to actually calculate this. You can see what we did is we took the average analyst earnings per share estimate and multiplied it by the 4-year average PE ratio. So again, if we come over here and look at the formula using ticker data, we're taking the estimated earnings per share average for 2028 and then multiplying it by whatever the company's 4-year average PE ratio is. So this is a very straightforward way of calculating price targets, but it can give us a general idea of what the stock might be worth. So again, this is a very general way of calculating price targets. It doesn't go very in-depth into the details, and we'll see that because I definitely think there's some cases where it's overestimating the stock's potential. For example, if we look at Pepsi, it's giving a 4-year price target of about $240, which would give it 77% upside. But a huge problem with Pepsi right now is their current PE ratio is significantly lower than their 4-year average PE ratio. Now, why is this the case? Well, this could be due to a few different reasons, but at the end of the day, a PE ratio tells you nothing by itself without accounting for the company's future growth potential. And we can see the 5-year EPS CAGR for this stock is close to 6%, but what management told us in their recent earnings report is we should expect earnings to be growing at a low single-digit rate. So think 1, 2, or 3%. So because Pepsi is growing their earnings at a slower rate, obviously people are willing to pay a lower PE multiple. And at the same time, if we jump over to my dividend breakdown sheet and take a look at Pepsi, thanks to ticker data, the data will load in, but one of the things we have to make note of is look at the free cash flow payout ratio for Pepsi over the last 3 years. In 2022, 110%. In 2023, 84.3%, and in 2024, over 100%. So that's a little bit of a red flag for a stock like Pepsi, paying out more in dividends than they're generating in free cash flow. So again, if you have interest in any of these stocks, you definitely need to dive deeper to make sure you understand the full picture. So what would I rate Morningstar's top 10 dividends? Well, again, at the end of the day, it completely depends on where you are in your investment journey. Like anything in finance, it depends. If you're someone who's at the top of the dividend growth pyramid, these are not necessarily the first stocks that I would start recommending. And if you're someone at the bottom of the dividend growth pyramid, again, these aren't necessarily holdings that I would be recommending. Now, 2 of the most frequently asked questions that I get is, so how would I personally build a high yield portfolio? Think of a portfolio with a yield of around 7, 8, or 9%, and how would I build a new dividend growth portfolio from scratch? I can't count the number of times I've gotten this question, so I'm actually going to be launching 2 real money portfolios over on Dividendology.com with complete transparency. One will be dividend growth focused and the other will be high yield focused. These will be 2 real money portfolios tracked with complete transparency. So be sure to check out Dividendology.com at the link in the description if you're interested in keeping up with that. But go ahead and let me know what you think of Morningstar's top 10 dividend stocks in the comments down below if you would buy or sell any of these stocks. And again, like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on on Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.